Did you even hear about derivative finance? If not yet, in the video we will find out about derivative finance and the commodity market, as well as something about likely finance contracts and legal regulations in this market, and how to enter Vietnam's investment commodities market. And welcome, we are Straits Vietnam. Today we will learn through 6 big pieces of content including general overview of commodity derivatives and commodity markets, the purpose of the market's birth, the history of its formation, and the legal basis for operating the commodity market in Vietnam. Next is to classify and compare the differences between centralized and decentralized markets. In the next 2 parts, we learn about the software used in trading and the market participants. Finally, learn about the types of contracts used in investment in commodity derivatives. First, we need an understanding of derivatives. These are financial contracts, or financial instruments, whose value is based on the price of the underlying asset, aim for different purposes, such as spreading risk, protecting profit, or generating profit. And commodity derivatives makers is a market for issuing and trading derivative products. The purpose of commodity derivatives makers is to help participate offering a transparent, global investment opportunity and great profit potential for individual investors from commodity arbitrage, helping farmers to be proactive in selling products at high prices and determining the profit they will get in the future, as a tool to help businesses ensure prices and avoid risks in the process of business and production. Regarding the development history of the commodity market, we have 3 major milestones. The first is the birth of the olive options contract in 600 BC, then the formation and merger of commodity markets, commodity exchanges in the world, and the advent of online trading systems. The process of forming a commodity exchange in Vietnam. December 28, 2006, Decree number 158/2006/NDCP stipulates the establishment of the commodity exchange and the trading of the commodity through the commodity exchange. September 1, 2010. License number 4596/GPBCT to establish the first commodity exchange in Vietnam. The 9th of April 2018. Decree number 51/2018/NDCP amending and supplementing Decree 158/2006/NDCP. The 8th of June 2018. License number 486/GPBCT to establish a commodity exchange. This is the license of the Ministry of Industry and Trade allowing the establishment of a commodity exchange in Vietnam. The above is the legal basis for the interconnection process of the Vietnam Commodity Exchange and other commodity exchanges in the world. Especially in 2018, the Vietnam Commodity Exchange was officially linked to trade with the Vietnam Commodity Exchange. International commodity exchanges interconnected. It is a fact that the commodity exchanges have an agreement to connect with each other, whereby the commodity contract of one commodity exchange is traded at the other and vice versa. Here is a comparison of the differences between the 2 types of markets. Exchanges. Commodity exchanges are centralized commodity trading markets, where participants perform standardized contracts, with terms set forth by the commodity exchanges. The commodity exchanges acts as an intermediary for all participants and requires the parties involved in the purchase and sale to deposit and comply with the terms of the contract. Over-the-counter, OTC. Unlike the centralized trading market, the OTC market is a private agreement between 2 parties and is not bound by strict conditions from the commodity exchanges. Exchanges. Centralized transactions and specific locations, volume and price are regulated by the market. Low risk, as the commodity exchanges acts as an intermediary, strictly regulating contract terms. The price level is less influenced by market participants. High liquidity. Over-the-counter, OTC. Transactions are not centralized. Volume and price as agreed between the parties. High risk, due to the partner not complying with the contract commitment. The price level can be dominated by a small number of large actors. Low liquidity due to a limited number of market participants. The model of commodity trading in Vietnam is operating as follows. Customers come to open a trading account and conduct transactions through trading members. Trading members connect to the Mercantile Exchange of Vietnam, MXV, and a service connects customers' transactions with commodity exchanges around the world. We will have banks between the parties for payment and money transfers. Customers' transactions are carried out through MXV with the mission of being the hub connecting exchanges around the world. Currently, the basic freight forwarding model in Vietnam has not yet operated, so derivatives investors will have to choose the arbitrage option and seek profit from market fluctuations. Participants in this commodity derivatives market include hedgers, those who participate in trading derivatives to hedge against the risks of adverse price movements. Speculators are people who take high risks in search of high profits from price fluctuations. They can be between a long position and a short position, or both positions for the same commodity, spread position. There are two types: position traders and day traders. Arbitrageurs. These are market participants with the goal of achieving profits without incurring any risk by simultaneously trading on many different markets. Types of transactions on this derivatives market today include outcry is a method of communication by hand gestures and words used by traders at the exchange. These symbols and chants are used to convey information, purpose and confirmation at the trading pit. Electronic trading. It is a form of transaction that is fully automated by a modern computer system to perform the following tasks: placing deviations, transmitting orders, matching orders, returning transaction results, clearing, and depositing. This form of a transaction has the ability to receive orders, transmit orders, and process orders quickly and accurately, thus meeting the increasing trading volume of the market. Algorithmic trading. The process of executing orders using automated and pre-programmed trading instructions for variables such as price, timing, and volume. Currently, when participating in commodity trading in Vietnam, investors will be provided with and use two software to manage participation and participate in commodity trading, which is M-System and CQG. Introduce those two software in the next clips. Here we will learn about the types of contracts in commodity trading. Derivatives trading currently has three types of contract instruments, including forwards, options, and swaps. Commodity trading in Vietnam is the most popular forward contract. Forward contracts have the main type of forward and futures contracts. Now we will distinguish this or this type. In this video, I will introduce forward contracts, because this is the most popular and most traded type of contract in the Vietnam market. A forward contract is an agreement between two parties to buy and sell an underlying commodity at a predetermined price in the future. The underlying commodity of a forward contract includes stocks, interest rates, commodities, bonds, currencies. How forward contracts work. On day T, Party A signed an agreement to sell 50,000 bushels of corn at 700 cents/bushel on T plus N to the Party B, and Party B signed an agreement to buy 50,000 bushels of corn and at the price of 700 cents/bushel on T plus N from Party A. On day T plus 1, ship the commodity to Party B for 700 cents/bushel and receive the commodity. Receive commodity and pay for the commodity at the price of 700 cents/bushel for Party A, even though the current market price is 720. Forward contracts are used for the purpose of hedging against market fluctuations, but forward contracts still have many risks for the participants, so to reduce the risks for participants, there is a futures contract in the market. Futures contracts are forward contracts that are standardized and listed for trading on commodity exchanges. Diverse types of commodities, agricultural products, energy, metals, major exchanges in the world such as CME, the ICE, LME. And there is a contract specification of the futures contract. Futures contracts operate according to the mechanism. On the day T, Party A place an order to sell 50,000 bushels of corn, 10 contracts, for the May 2022 term at 700 cents/bushel. Party B place an order to buy 50,000 bushels of corn, 10 contracts, for the May 2022 term at 700 cents/bushel. On the commodity exchange, on day T plus 1, Party A ship the commodity to Party B for 700 cents/bushel and receive the commodity. Party B receive the commodity and pay for the commodity at the price of 700 cents/bushel for Party A, at the current market price of 750. Futures contracts are superior to forward contracts because the contract is listed and standardized in terms of quality and price according to the provisions of the commodity exchange and has the commodity exchange as an intermediary for payment and clearing. Except to ensure that the parties to the contract perform, for hedging investors, carry out the delivery of a physical commodity at a predetermined price. Arbitrageurs can close the position before the maturity date and receive the profit/loss arising from the transaction. Highlights of the futures contract. Standardize. The contract elements are standardized according to the specification. Centralized trading. Listed and traded centrally through the commodity exchange. Liquidity. Easy to open/close position. Financial leverage. Leverage is applied when trading. Clearing and margin. Deposit when trading. Daily clearing. Here is a comparison table between the two types of contracts. About forward contract. Direct transaction between buyer and seller, not standardized. The content of the contract can be adjusted according to the needs of the two partners. Paid at the maturity of the contract, when the two parties participate in the delivery process. Mainly delivery of the commodity or cash payment upon contract maturity. Low liquidity. There are many risks such as counterparty risk, payment risk, etc. And futures contract, centralized trading on commodity exchange. The contract is standardized by the commodity exchange, paid daily after each trading session according to the market anchor mechanism, mark to market. Mainly closing contract positions before contract expiration. High liquidity. Virtually no counterparty or settlement risk as it is managed through margin management and clearing. And that is the last content in this video. Thank you for watching. In the next videos we will continue to learn about margin and software used in commodity trading in Vietnam.